Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Today, joining me is Joel Baker, our Chief Investment Officer. Joel, welcome.
Hi, Mike. Thank you. Thanks for
Great to have you here.
thanks
So
for inviting
today,
me.
what we'd like to do is talk about, basically our overall investment outlook. As we look at the current earnings season, what are we seeing?
What are we seeing? Yeah, that's a great one. Yeah. So to kind of put it in context, we're definitely knee deep in earnings seasons right now. That's for sure. So I think at the start of the week, it was about half of the companies had reported. So we're definitely knee deep in going through those. And I can sort of tell you, like, so far it's kind of a common theme in that the supply chain disruptions are still in everyone's headlines. That's still going on out there, and continues to be a lack of employees. And again, it's interesting in our chairs, we talk to many different clients in many different industries and segments, and it always seems like the story is the same, and that they're having good years, if not record years, and they'd be having record years if they could find more employees. And
Right.
it doesn't matter whether you're a farmer or a veterinarian or a widget maker; it's always sort of the same sort of story. And yet we read the opposite. So in the States, we're reading more and more about corporate layoffs and big layoffs. And I'm sure we've all sort of seen the headlines with Amazon and Peloton and even Twitter in the news. So to kind of put it in context, back to your question, Mike, so far what we're seeing is that earnings are okay. I wouldn't say that they're stellar, but they're
Right.
okay.
Right.
So to kind of just give you a sense of that. So about every 10 companies, 7 are actually beating earnings estimates. So both in terms of earnings and revenues. So that's great news. They're beating them by about, on average, say 2%, again, to use sort of a general sort of number. The bad news is that the trends are going down. So the growth rates are slowing. We're sort of seeing that sort of trend in the numbers. So that's sort of the bad news, is that it is sort of a slowing down trend. But good news isn't that they're sort of beating consensus estimates. So that's sort of why I say they're okay but not stellar.
Right. So, I mean, to a certain extent, do you feel the slowdown we're starting to see is, a direct or indirect result of what the central banks are doing?
Yeah, for sure, and even kind of on a different vein, it's really becoming a game of margins. So as we're looking at the earnings statements, it's really a degree of who can pass on that inflation or higher input costs to us consumers, and who
Right.
can't, who
Right.
has to fight that in their own income statement. And it really becomes a game of margins in terms of how well the statements look. Another biggie is the U.S. dollar. So again, as Canadians, if we have to buy something in U.S. currency, it's hard. It's difficult. So imagine yourself if you were a business and had to buy some of your input costs in U.S. dollars. It's definitely going to hit your margin. So that's another
Right.
biggie for sure.
So given this, how well are our clients positioned through this season?
Well, they're pretty well. If to sort of use that sports analogy, we're definitely playing more defense than offense. It's really that simple. And at least right now, I think that the clients were benefited in two sort of ways. And really, what I mean by that, Mike, is we're trying to position it for protection against higher interest rates. Obviously, that's
Right.
a biggie in the news today. And the other is just kind of recessionary proofing the equity side of the portfolio. So maybe just to drill down a little bit of that. So what do I mean by that?
Mm-hmm.
So on the rising interest rates fronts, we're trying to protect the bond side of the portfolio by keeping what they call our duration short. And really that's a fancy term for keeping our bond ladders short.
Right.
So obviously we're not sort of making bets on where the yield curve is gonna land in or where it's gonna lie.
Right.
We're kind of playing it safe, so that as people's bonds come due every year, it's then reinvested into the longer end of the ladder, which is usually a higher rate.
Right.
So to kind of put it in context, we've got bonds kind of rolling off this year at say 2%, going back into the bond market at say 5.5%. So again,
Right.
it's just a good way of recessionary proof in terms of fighting rising inflation on the effects of the fixed income side of the portfolio.
Now, the terms of those in the new bonds are still relatively short, though, say 5 years.
Exactly.
Yeah.
Exactly. Yeah,
Okay.
we keep it
Okay.
5 years and under for sure. Yeah, for
Yeah.
sure. The other angles is preferred shares. Again, we want to make sure we've got good exposure to those offering rising dividends in these inflationary sort of periods. So again, really, it's a case where the dividend mechanisms in those preferred shares are tied to interest rates. So obviously, you want to be aligned with those
Right.
mechanisms that benefit from rising interest rates. So again, it's just another way of sort of protecting the inflation proof of the portfolio kind of thing. So
Right. Now, you mentioned the I word, inflation.
yeah,
So,
yeah.
if you You know, what I'm seeing some, call it some positive trends, seeing some commodities coming down. What are your thoughts there?
Yeah, for sure. We're starting to see some effects of inflation coming down. You're exactly right. We're sort of seeing some things in commodities coming down. Um, Fuel is kind of a bad one because it's up and a down depending on which day, but definitely that's one for sure. We're seeing commodities come down. We're seeing things like used car prices come down. You know, we're seeing
Right.
houses coming down. So some of the effects are happening. What the Bank of Canada is hoping that will happen for sure. So
Right.
um, the other side of that coin is, you know, we're talking about equities there and dividends, and one of the things we're trying to build into the equity side of the portfolio is recession proofing. And really what I mean by that is we're buying what we think to be high quality companies that pay good dividends, that pay, you know, rising dividends. And obviously we've got good, strong cash flows supporting those dividend payments. That's always very, very careful and very, very important too to investors. So we want to make sure that we're buying those what we believe to be high quality companies that are going to withstand any sort of, you know, world shock or recessionary, you know, trends coming around the corner. So at the end of the day, they're going to be there at the end of this economic storm, should it roll out into a global recession. So
and we do make adjustments. Like we had an episode recently with Krishna Behari, and he talked about some of the adjustments we were making relative, you know, the sector, the utility sector, right? Correct, so we do make those adjustments.
Correct. Yep. All of the sectors kind of move in different speeds and different magnitudes. Obviously, not all asset classes move in the same direction and the same speed. So again, we're big fans of diversifying. So we don't want to make big bets, you know, call it sector bets, if you will, with our clients' capital. So we just don't want to be on the wrong side of that call. So we're big fans of diversifying across the portfolio to kind of, again, recession proof or bulletproof the portfolio. Excellent. We always say we try and build sleep at night portfolios.
Sleep at night portfolios. I love that term, the whole quality approach to our investing.
Yep.
Good stuff, Joel. Well, thank you. Thank you for informing us to see, you know, how things are going. So very much appreciated.
Anytime.
All right, folks. As always, if you have any questions, don't hesitate to reach out to myself. And as always, don't hesitate to reach out to your individual portfolio manager. Thanks a lot.